There's no stopping the markets, even a war. The PSEI and the S&P 500 rallying despite unsteady news last week. Are we going to break the October curse? Let's discuss. My name is Den Slim and welcome to another episode of Monday Market Outlook. The Middle East conflict has intensified with Iran firing 180 missiles early last week in response to Israel's assassination of Hezbollah leader Hassan Nasrallah. At the start of the week, markets have begun factoring in the likelihood of Israel retaliating by targeting Iranian oil refineries, which drove oil prices up 11.2% to $77.73 per barrel just last week. When asked if the US would support an Israeli strike on oil refineries, Joe Biden actually answered, "We're discussing it." This sent Brent and US oil prices to surge, 3.7% in a significant one-day jump last Thursday, But despite the tensions overseas, PMI numbers in the Philippines hit a 20-month high, coming in at 53.7, the highest in the region, driven by robust domestic demand. But weak international demand and supply chain issues will still act as headwinds in the manufacturing sector. BSP also released data on hot money for August. Data showed the majority of the inflows at 51.2% were invested in securities listed in the Philippine Stock Exchange, particularly in banks, transportation, holding firms, property, as well as food and beverage stocks. The remaining 48.8% went to investments in peso government securities. Later in the week, inflation numbers surprised the markets, clocking in at 1.9% versus the 2.5 median expectations. A welcome news, especially for consumers who have been feeling the pressures of rising costs. The 1.9% figure marks a 4-year low for Philippine inflation, easing from 3.3% from August, which also puts the full-year inflation number to just 6.1%. Now, despite the geopolitical news, the markets has generally been bullish last month. The PSEI actually the fourth best performing market, gaining 8.1% in September. Even the S&P 500 managed a 5.1% gain, defying the September trend. On a weekly basis, though, the PSEI was still able to eke out a 0.53% gain for fifth place, just behind the S&P 500. The markets remained strong off the favorable economic data last week, as well as bullish pronouncements from Governor Remolona on the possibility of zero RRR for banks during his term, which will end in 2029. So this really is quite a bullish outlook for the governor on the Philippine economy. Now, meanwhile, the BSP is set to reduce rates by 25 basis points in their October meeting and another 25 basis points in December. And for 2025, they are set to reduce rates by another 125 basis points. So central banks looking to ease rates at a much slower rate compared to the rate hike cycle that started in 2022. At this rate, we're projecting interest rates to go down further to 4.5% by the end of 2025 versus the Fed funds rate projected to be at 3.5% also by the end of 2025. Now, let's look at the PSEI charts. The index overcame Monday jitters to bounce back strong towards the end of the week, hitting a new 52-week high at 7,467. Now, the last time we closed along this zone was in 2022 when the PSEI closed at 7,502. The market very bullish coming into October. Price action remains healthy, managing to stay within this zone 7,500 and 7,300. Now, the PSEI has hit into this resistance zone twice in the past 2 weeks. The oscillators showing a bit of weakness. Now, if the market pulls back, this could look like a double top formation, which may lead into the pullback to 7,000 or 7,100. So hopefully we could see the markets move along this range in the coming weeks, but it looks like the markets could remain bullish and maybe even break out off the backs of the prospects of a soft landing in the US. And it's also quite surprising that we ended on a weekend with a green candle despite potential tensions in the Middle East, right? So let's look at some stock highlights from last week. A-REIT rallying to 38.10 from a low of 36.60. It almost hit our buy the dip price 36.50, but actually 36.60 not a bad price to pick up A-REIT. Congratulations if you were able to do so. China Bank finally rallying to 59, with the other second line banks taking a break this week. Both stocks are reportedly the leading candidates for inclusion in the index next year. And of course, the question is, who will be taken out of the index? Word on the street, nickel is one candidate, as well as Wilcon Builders, possible candidate. So for now, I guess it is best to stay away from these stocks, right? Now, for this week, not too many options. Last week, we featured Monde. It has done quite well. Again, we are seeing this formation resulting into a breakout. Congratulations if you were able to pick up Monde. Manila Water also doing quite well. We're seeing some selling pressure here, but so far bouncing off of the 100-day EMA. Of course, some of our riskier picks, Apex, not doing quite well, consolidating along the moving average resistances. JGS also encountering some difficulty breaking through the 100-day EMA. So let's talk about a good question a lot of people have been asking me. Isn't it better just to hold on to a stock of a great company, hold on to it for the long term, right? Instead of trading it, top slicing here, buying back here, etc., right? I mean, okay, my answer to that, yes, definitely hold on to your favorite stocks for the long term. This is an investment game. This is not, a trading game. But my answer is also no, not exactly. Now, I'll show you an example. You guys know that my favorite stock is A-REIT. I have been holding A-REIT ever since it IPO'd back in 2020, right? So I bought A-REIT at IPO price 27. I bought more when it dipped to 25. I bought more when it rose up to 29. I held on to A-REIT until the stock reached an all-time high of 52 pesos. So my average here, if you can see here, that my average cost for A-REIT is 27.44. That's almost IPO price, right? Now, when the stock hit an all-time high here, I remember this because I posted this on my Facebook profile. I sold 10,000 shares of A-REIT. Now, what was the trigger for the sell? If you look at interest rates, right? US interest rates and PH interest rates, right? What was happening during that time, right? The rate hike cycle was already starting, right? So, as A-REIT was reaching all-time highs, look, the US increased rates by 50 basis points, another 50 basis points. It's just a matter of time before the Philippines started to increase rates aggressively at that. So, what is the relationship of interest rates with REITs, right? Look at this. As interest rates go up, the price of REITs will go down so that the dividend yield of REITs will match the interest rates. As you can see here, REITs hit their bottom when interest rates peaked back in 2023. What sectors benefited from the high interest rates? Of course, banks. So we were heavy on banks during that time. You see how the banking stocks perform when interest rates go up. BPI also, right? See, Metrobank also, even if Metrobank was a laggard, eventually it caught up. If we go back to A-REIT, I started buying back A-REIT here at around 2023, and the buybacks lasted for a year until around April of this year, right? Because there was no opportunity after that, right? So I was able to buy back 15,000 shares. My average price has, of course, gone up to 29.68, but now I have 22,000 shares. So with the same amount of money that I sold A-REIT for, I was able to buy back 5,000 more shares of A-REIT during the course of 12 months. What did we gain here? Now, I now have 5,000 more shares earning 2.24 per share in dividends. So A-REIT price is now at 38. Not counting the capital appreciation there, that's 11,000 additional dividends per year. So yes, we have transaction costs. The total here probably 6,000 pesos selling and buying it back. in the course of what, a year? I mean, that's fine. Your broker's not going to be rich by you giving them like 2,000 pesos in 1 year. Broker commission, that's the cost of doing business, right? As long as you gain more than what you pay broker's commission, and that's fine. We don't trade every day. We don't trade every week. We don't trade every month. But we need to lock in profits when economic condition tells us to do so, and REITs are easiest to predict because they're quite sensitive to interest rates. So yes, you hold on to great companies, but one should know when the stock has become too expensive for its own good, and when the stock is at a great bargain. Even Warren Buffett, the greatest value investor of all time, diamond hands is not part of his investment strategy, right? He will shift his position, no, depending if a stock is cheap or expensive, and he will shift to a cash position when economic conditions points to a bleaker outlook. Let's continue to look at the interest rate outlook here, right? So we are in the rate cutting cycle, right? So what we're saying is that what the Fed's saying, or what we're predicting, is that the Fed rates will be at 3.5% by the end of 2025. The PH interest rates would be at 4.5% by the end of 2025. So that means that we are projected to trend at 3.5%. We are projected to trend to 4.5% by the end of this year. So look at how interest rates are projected to go down. So if interest rates going up has this effect on REITs, what effect does this movement of interest rates have on REITs moving forward, right? So we can safely presume that it's going to slowly go up. If we look at RCR, we can see that inverse pattern happening, right? So as rates go up, RCR went down, and as rates become steady, it bottomed out and it's slowly going up. C-REIT, it's the same scenario, it's the same case, right? See how it goes down, but this goes up, it peaks here, it bottoms here, and starts to go up. What about banks? It's going up here. What happens if this goes down? So presumably, banks will also either go down or just remain in a holding pattern for what? For the next 2 years, right? So we are looking at a 2-year outlook here, because the rate cut cycle is not going to happen as fast as the rate hike cycle, because I mean, if rate cuts happen as fast as this, that means there's something wrong with the economy, right? Because central banks will only be forced to cut rates as aggressively as they raised it if there's something wrong with the economy. So as long as rate cuts go on a steady decline, then we can assume that REITs and the property sector will have a very positive outlook in the next 2 years, right? So I'd like to recommend this book to everyone, no? If you have time, read this book, The Psychology of Money. It's a great book on value investing. There's a section in the book that provides some insights on the win rate for investing in the stock market. If you invest in the stock market for just 1 year, the probability of earning a positive return is 53%. For 5 years, it goes up to 70%. For 10 years, it goes dramatically up to 90%. And if you've been invested in the markets for 20 years, the possibility of a positive return is 100%, right? So onto the global markets, a slew of labor data came in last week. The JOLTS numbers came in hot, clocking in at 8.04 million job openings in August, which was up from 7.71 million in July, which was also upwardly revised. No? Job quits are at their lowest, so the labor market still showing signs of strength. This was confirmed by Payroll Friday's numbers. 254,000 payrolls were added in September, which is much better than the 150,000 expectations. Unemployment rate fell to 4.1% in September. So last week's employment numbers suggest that companies aren't in a rush to lay off workers, nor are they aggressively hiring workers as they did before the pandemic. So this balance might indicate that the labor market is in a sweet spot, allowing the economy to move forward without reigniting inflation. At least that's what the market is trying to factor in. And with the succession of positive labor data, the chances of a 50 basis point rate cut has tumbled to just 7.5%, much lower than the 32% just one day before. And remember, last week this was at 53.3%. So with that uncertainty out of the way, the S&P 500 rallied on Friday after a choppy start last week, and it managed to stay within this bull zone here at 5,700 to 5,780. Better than expected employment data fortified the soft landing scenario. This helped US major indices to recover into slightly positive territory for last week. So what? We have a healthy labor market, a dovish Fed cutting interest rates moving forward. Now we've stayed above the 20 EMA so far, and with this mean reversion, the markets could be setting up for another rally coming into this week. Now, I still like the idea of a pullback to 5,650 or 5,480, but price action for now says that's highly unlikely, and the markets could continue to celebrate coming into this week. If we break through 5,780, that would be very bullish, and we could look at 5,800 or 5,840 as the next resistance levels. But we'll see. Looking at the economic calendar, PH unemployment rate on Tuesday and the balance of trade on Thursday, while US will have the inflation numbers on Thursday. Looking back, we haven't had really this much fun in the PH markets for a long time, because previous rallies were really short-lived, and this is really a welcome change for Philippine stock market investors. And in this bull market, just hold on to your winners, enjoy the show while you can, don't chase prices at this point, right? So that's it for this week. Please like this video. If you found the information useful, please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly, and I'll see you again next week. Bye-bye.